What does U.S. Federal Reserve independence really mean in practice? Is there usually this type of pressure on the Fed from the White House? Scott McIntyre and I get into the issues and what it could mean for the market and public finance. Thanks for joining us on the Hilltop Talks podcast. This is Tom Kozlik, Head of Public Policy and Municipal Strategy at HilltopSecurities. Thanks for joining us for this first episode of our Hilltop Talks Politics and Finance podcast series for 2026. In these conversations, we talk with subject matter experts about the areas where politics and finance collide at the federal, state, and local level in the U.S. We often focus on topical market issues, U.S. public finance, and the municipal bond market. Today, we are zeroing in on the importance of the Federal Reserve, its independence, who may be the next Fed chair, and what the period between now and May could look like. I am very happy to be joined by my colleague, Scott McIntyre from HilltopSecurities. Scott is the co-head of investment management for HilltopSecurities Asset Management. Scott thinks about the intersection all day, every day. And he's here. He's going to help us separate the important signals from the noise. Scott, thank you so much for being here with us.
Thanks, Tom. Tom and I talk quite a bit, so this is kind of a pleasure to make it more formal. But when Tom talks about us talking, or me thinking about this all day, every day, that probably is a bit of an exaggeration. But obviously, in the market, there is the link between politics and the Fed and the markets and investing has never been as tight as it is at this point in time. So, Tom, you're exactly right, and I appreciate being part of this, and I hope that this is a good a conversation as the ones that you and I typically have.
It'll be better. I promise it'll be better. As I'm thinking about it, most people don't wake up thinking about monetary policy or Fed governors or the FOMC. They're thinking about oftentimes Indiana's undefeated season, groceries, housing, whether or not there's going to be traffic on the way to the office. But events surrounding the Fed and Fed independence is becoming increasingly important to people's everyday. The Fed sits right in the middle of almost everything impacting the financial markets. When the Fed and its message is steady, the backdrop is often quiet. When or if the Fed wobbles, everyone seems to hear it. Now, strong markets help, but they can also raise the stakes if policy or politics push too far. Today, we're going to talk about what is solid, what is at risk, and what followers and observers should be watching now through May and beyond. So, Scott, the threat to Fed independence has been a heated issue ever since President Trump re-entered the White House at the beginning of last year, the beginning of 2025. Is this a legitimate threat? And what is it that how is this threat materializing? What does this threat look like?
It is absolutely a legitimate threat. I think the markets perceive it that way, and because the markets perceive it that way, it certainly is. We have taken for granted, in my opinion, Chairman Powell. I think that he is extremely well respected by the financial markets, and you can see that especially during his press conferences after the FOMC meeting. If you watch the market in real time, you can see how the markets react to what he says. He's got a very calming influence. It's been around for 8 years, and during those 8 years, obviously they've been very challenging years, and the markets have just gone up. And we can credit a lot of things for the idea that the stock market continues to climb, but I think the Fed chairman and the respect that he's garnered and the integrity that he shows is one of the underlying reasons. So we're really challenging that with the idea that we would bring in another Fed chairman who was inclined to move at the directive of the president. And that's really what it's about. Monetary policy, the Federal Reserve, has two, as you know, Tom, as we all know, it has two major directives, and one of them is to keep inflation at or near its 2% target. That's the goal anyway. We're about 2.5% to 3% now for core CPI, but that's the goal. And at the same time, they want to have employment at well, full employment, whatever full employment is these days. And I guess that's just a whole nother question and a topic for another podcast. But market integrity is important. And I think whenever you've got a Fed chairman who comes in who is, again, acting on behalf of the president, not necessarily on behalf of what the markets are dictating, is an issue.
So do you think, Scott, that the issue of Fed independence was kind of taken to another level, or the questions about Fed independence were taken to another level a week or so ago, when the Fed chair released that video on that Sunday evening? Could you want to talk about that a little bit and tell us whether or not you think that that raised the stakes of Fed independence and what the reaction of the market was?
That was interesting. And what Tom is talking about is Powell reacting to all the pressure that he felt from the president. The Chairman Powell has been attacked repeatedly by President Trump because Chairman Powell is not lowering interest rates to the extent that President Trump would like that to be the case. So he has hoped that Powell would resign, and he's putting a lot of pressure on him to resign. And one of the things that happened a week or so ago was that a probe was launched to investigate the Federal Reserve, and in particular Powell, for basically there's a Federal Reserve building renovations are ongoing right now, and the prices of those renovations are spiraling. And Chairman Powell has been accused of testifying in a manner that Trump didn't like. So Powell pushed back on that really hard the other day, released a video that in essence said that the Federal Reserve was going to remain independent, pushed back hard against the president. It really pointed out that these attacks on him and the probe into the Federal Reserve were motivated by things other than monetary policy and the way it should be. So I think that the fact that he did push back in that video was probably a positive for Fed independence, in that the markets perceived that Powell was not going to go away. That Powell was going to stand strong. That Powell was going to put his foot down. And one of the things that I think we all came to realize after seeing that video and how strong he was the possibility that Powell would actually stay on. His chairmanship ends in May of this year, and that means that he's not going to be chairman after that, but theoretically he could continue on as Fed governor until January of 2028. And if he does that, then the president would not get to appoint a replacement for him on the board of governors. And there are 7 board of governor members. There are 7 Fed governors, I guess I should say. And these guys vote at every single meeting. So there's 12 FOMC members that get to vote at every FOMC meeting. 7 of them are the governors. So the governors are important because they get a vote at every meeting. If Powell were to leave and Trump were to replace him with a Fed governor who was inclined to, again, do the bidding of the president, then that would obviously give him one more vote. And one of the things that came up recently was, I had to actually Google this. I had to go to Copilot and ask, because I'm not sure if most of us knew this, but it takes 7 of the 12 votes to enact policy at the Federal Reserve. It's not a 6-6 with the chairman getting the deciding vote. It needs to be 7-5 or better. So the idea of a Fed governor staying on the way Powell would if he decided to do that is very important in terms of Fed independence. So in answer to your question, I know I'm getting long-winded, which I have a tendency to do. Powell standing strong against the pressure from the president is a positive for Fed independence. And we'll leave it at that.
So are you expecting that this type of pressure from the White House is going to continue? And is this kind of pressure towards the Fed and Fed chair, is that normal? Have we seen that in the past?
So I do believe that regardless of who the new Fed chair is, I think that pressure is going to continue. And I think that pressure will be extended to the regional presidents as well. So I think that
Mhm.
the president feels very comfortable weighing in on monetary policy. I don't think that's going to change. There's no reason to believe that it will. As far as whether or not that is normal, it it's not normal. Obviously, it's certainly not normal in the way it's happened. I mean, we're in an era where the president can post on social media, which didn't exist obviously 30, 40 years ago. But if you go back 30 or 40 years, um, President Reagan knocked heads with Fed Chair Paul Volcker. And what happened was that Reagan came into office in, I guess it was 1980, and inflation was really, really high. And the only way that Paul Volcker, as the Fed chair, could control that inflation is by raising interest rates and throwing the economy into recession, which basically killed demand and brought prices down. And obviously, last thing in the world Reagan wanted was to have the economy move into recession when he just became president. So they butted heads on that, and the Fed chair won, and inflation came down. Now, recently, just because of Trump's relationship with the three potential Fed chairs, we sort of dipped further back into history, and Nixon had a friend who he appointed as Fed chair, and that was a gentleman by the name of Arthur Burns. And Reagan wanted Arthur Burns to lower interest rates, and the economy was very hot, very similar to the way we are right now. Strong economy, plenty of spending, a lot of money rattling around. No apparent reason to lower rates, but the president felt like he wanted rates lower, so he pressured Arthur Burns to do that. Arthur Burns didn't lower rates, but he kept interest rates where they were, which was a mistake. And a lot of people look at Arthur Burns and believe that he had a lot to do with the fact that inflation then subsequently rose
Mhm.
and knocked Carter out of orbit. But so there is examples of that. There was a lot of pressure on Arthur Burns. There was a lot of pressure on Paul Volcker. But for a long period of time, we hadn't seen that. We certainly hadn't seen the level of anger that Trump has shown toward the Fed chairman. It's certainly not the name calling that the president has shown.
And right now, markets are kind of gaming scenarios about potential successors. Which profiles feel plausible, do you think, given the circumstances that you're kind of talking about related to history? I know that there was a Wall Street Journal article last week comparing the two Kevins, right? Going back to, I want to say, November, December, President Trump was really pushing for one of the two Kevins. And between last week and this week, it seems as though there, at one point, there was somebody who was likely to be the successor, one of the two Kevins. But then it looks like that the potential of who it is that could be kind of rising and who's falling, it looks like it's changed a little bit. Who do you expect to be the next Fed chair?
So to your point, I think that the first trial balloon was Kevin Hassett,
Hmm.
and I think that balloon is deflated. I don't think that
Yeah.
he is going to be appointed. He just didn't bode well with the financial markets, and I'm not sure how credible he was. But one of the things that Kevin Hassett certainly would have done is he would have lowered rates dramatically. Um, Again, I think the markets didn't like that. I think that Trump has backed away recently. I think that Kevin Warsh, who is a former Fed governor, he served from 2006 to 2012, so very experienced. I think very well respected. Um, yeah, Probably should be next in line, and I wouldn't be surprised if it wound up being Kevin Warsh. And I think that he would make a good Fed governor. The other one who seems to be in the hunt is Chris Waller. He is a current Fed governor. I think that Waller is very well respected. And frankly, at this point, Trump really hasn't shown his cards between the other Kevin and Chris Waller. I suspect that it will be Warsh.
Hmm.
Um, and the reason I think that is that Waller has notoriously been hawkish. In other words, he is inclined to raise rates. He's more afraid of inflation than pro-growth. More recently, I think that he has pivoted to being dovish. In other words, he's more inclined to cut interest rates. But the reason that he's more inclined to cut interest rates is not because he wants to uh, satisfy the president's wishes so much as he believes that inflation will move sharply lower in the coming year, and he feels like that Fed will be able to cut. So my guess is that the president is talking to both Warsh and Waller and trying to determine exactly how inclined that they might be to lower rates. Um, honestly, I think that either one would be fine. I think again that Hassett would have been the bad choice, and everyone realizes that now.
Yeah, I've been following the numbers on Polymarket pretty closely. Last week, the odds for Warsh were up around just under and just over 60%. They've fallen down to 42%. Waller now is at almost 13% and Hassett at 7%. So that's what we're looking at now. But even between last week and this week, those numbers pretty substantially changed. So, but that's what it looks like right now.
Yeah, and it's all about credibility. And we
Yeah.
went for a long period, as I mentioned before, with Powell having the credibility of the markets, and I think that either one of those gentlemen would certainly be credible, and that's what matters right now.
So the big question in the near term for the market and especially for investors, Scott, do you think the Fed cuts this year? If so, when and how many times? Not to put you on the spot, but let's be honest. That's what everybody's thinking. That's what everybody's tuning in to find out.
Yeah, yeah. Well, so there is a wide there's a wide range of expectations for that, and that I guess that's not unusual over the course of the last several years that there's wide expectations, a wide range. I am inclined to think that the Fed cuts between 2 and 3 times. Obviously, they're not going to cut next week. March might be a little bit early, but then you roll into May and you've got a meeting again in June. I am more inclined to think again that it's 50 to 75 basis points. I think that there's upside there if the president pressures Fed members. But again, there are a lot of folks who believe it could be quite a bit more. And again, the president would like to see the overnight rate down to 1%. So we're currently at 3.5 to 375. So that would be quite a dramatic cut in interest rates, and probably very, very unlikely. And in the event that the Fed did decide for whatever reason, maybe the pressure just gets to the Fed members and they do make really dramatic cuts, I think you risk stoking inflation, and that's a situation that certainly the long end of the bond market would not like one bit. And I don't really want to go off into the weeds on this, but I do want to mention that the 10-year Treasury note, I'm not looking at my screen right now, but I know as of yesterday was at about 426. And the interesting thing about that is that if you go back to the day before the Fed started cutting interest rates, and they subsequently cut interest rates by 175 basis points, that's the overnight rate. The 10-year note was trading at 362. So 362 in September of 2024, the Fed cuts 175 basis points on the overnight rate. Here we are today with the 10-year note at 426, so significantly higher. And a lot of that has to do with the idea that it has to do with inflation expectations. So the Fed could cut the overnight rate, but if the market perceives that that was not the correct thing to do, you could have yields on the long end rise. And long yields are what impact mortgage rates and other lending rates. So, in essence, what the president would be trying to accomplish by pressuring the Fed, if the Fed was responsive to the president's wishes, would backfire entirely. And that's what the issue is here. That's why Fed independence is so important, that they watch inflation and they watch economic growth and they watch employment and make their decisions based on those factors and not the wishes of the president.
And just to remind listeners, Scott and I are recording this on Friday, January 23rd. The Fed is meeting. They're going to make their next announcement on January 28th. And most are not expecting the Fed to make any changes next week. They've already moved the target rate lower for 3 consecutive meetings, right? So if it doesn't do anything in January, then as Scott was just talking about, there's a meeting in March, there's a meeting in April. Those are the next meetings before Powell's appointment ends in May. Um, so Scott, you've already said you're not expecting in January. How many more could we expect something before the Fed meet before there's a new Fed chair in May, and or is it too far away to say what might happen after that?
Well, I'm guessing based on, or I'm expecting based on what we're watching in terms of prices that we're going to see a higher core inflation rate as of December. And I think that's going to certainly, it has tied the Fed's hands up to this point. I think that probably precludes them from moving in March.
Okay.
The May meeting, I would expect, because that is right around the point that we get a new Fed chairman, that the Fed would not be moving. But frankly, all of this really depends on where inflation is and where the labor market is. So
Okay.
assuming that the job growth is anemic, which has been for a while, the Fed will be inclined to cut rates. I
Okay.
mean, but then you have to see inflation cooperate. You have to see inflation continue to come down. And what that means is that core inflation settles in somewhere at or below 2.5%. And that's a great big wild card right now, especially with the whole tariff issue back on the front pages. So we got a lot to watch. It's not unusual. This is such an unusual time in terms of politics and economics coming together. But I do think it probably won't be until May at the earliest, June more likely. The 3 cuts may happen all before the midterm elections. So
Okay.
June, July, and I think September probably would be the most likely if there were to be 3. But
Okay.
again, it's all going to depend on whether inflation is reasonably well behaved.
So there is some
And
data dependence there, and you mentioned a potential May move. I think you were meaning to say because the Fed is not meeting in May, they're meeting on April 29th. I think you're referring to April 29th, right?
yeah, I guess
Yeah,
I think this past year was in May, but yes, it's the
exactly.
end of April this
Yeah,
coming year. Yes.
yeah.
You
Okay.
know, it was interesting. I was going to correct you, and I'm glad I didn't because I'm not looking at a calendar right now, and obviously you're right on that one. But thank you.
That's all right. Well, hey, I mean, that's a great overview, I think, Scott. I mean, this is what it is that you and I talk. This is exactly what it is that you and I talked about doing. I think that we've accomplished the goal of staying within about 20 minutes and hitting on all these uh, big picture themes and topics. Um, I think it's a good time to close out the discussion, as unless there's anything else that you wanted to chat about.
You know, again, Tom, you and I could go off on a million different
We
tangents,
really
and there's
could.
always a lot to talk about. But I think that this wraps it up
Good.
effectively for 20 minutes,
Great.
and
Well,
we'll do it
Scott, thank
again.
you. I really enjoyed this discussion. Thanks to everybody who tuned in and downloaded our podcast today. Thanks very much, and thanks very much for your support. Again, Scott, thank you for joining me today. I enjoyed
Of
the
course.
discussion. For those interested, you can see the Hilltop Securities economic and municipal commentary and listen to our podcasts by going to hilltopsecurities.com/insights. You can follow me on X and LinkedIn. I have commentary on that insights page, and Scott has commentary, very regular commentary that is very, very good on that commentary page, on that insights page. And there's a way to sign up for both the municipal and the economic commentary there. Again, thanks everyone. We look forward to bringing you more color in the future related to topics that intersect the world of politics, finance, and public finance. This has been Tom Kozlik, and Scott McIntyre from Hilltop Securities.